On today's show, 3 questions. Number 1, do we have a reason to cut interest rates? Number 2, is the student loan party over? And number 3, how much should you spend on vacations? Welcome to Dennis Money's 2 cents, where we help Dennis navigate all the noise. I'm Matt.
I'm Rabih.
Yeah, you are. And you're getting a shout out today, Rabih. An
What's
extra
up?
special shout out. You won't do this, so I'll do it for you. On Wednesday of this week, Rabih, our very own Rabih Dimachki, did a defense of his master's thesis at the University of Utah. He's just completed his master's in econometrics, correct, Rabih?
Yes.
We had a watch party. So the whole team got together and we were watching on Zoom. It was awesome that we could be there and watch Rabih just dominate. And it's not just me who says he dominated. They finished. They did all their questions and stuff after. Before they did the mysterious, everyone has to get off so we can talk to you, Rabih. That was funny. But afterwards, after they did their questions and things, Rabih gave me a shout out. You said something about me, like to the panel. And I think it was like the main person there he said, hey, since your boss is there, I want to make sure that he knows this was one of the best, this is exact quote, one of the best master thesis defenses we've ever had at the University of Utah. So doesn't shock me at all, Rabih, but honestly, want to go on the air and give you the credit that you deserve. I know you put in so much work into that thing and you absolutely killed it. You deserve it.
I appreciate it. Thank you. And I'm super happy and grateful for you guys for supporting me because you guys intimidated them.
Did
And
we
they did
scare
not
them a little?
ask me questions as hard as they should be just because you guys came in for me. Thanks.
So I got on a few minutes late, or I got to the office a few minutes late. The party had already started and you were already going. So they knew we were obviously on?
Yeah.
Okay.
I started telling them that I've got friends and coworkers on this call, so it's going to be busy.
That's awesome. I love that. Can you tell us what they said? They made us get off, and then what they have to give you, like, then they got hard on you?
No, actually, so they kicked you guys off the Zoom and they kicked me out along with all the other audience that was in the room who was not part of the committee. And we were just chatting outside for 2 minutes and then they opened the door and asked me to come in. And so there were 2 in person, 1 on Zoom, and they lined up and they put the computer next to them. So they look like they're standing in line. And as I went in, they shook my hand and said, congratulations, this is really great. You should expand it into a PhD and we're here to help you. So the interaction before leaving the room is completely different after entering the room. Like the whole dynamics shifts and now they look at you with respect. It was funny, but it was
That's
great.
awesome. So did you fake Zoom air handshake, the person on the Zoom?
I actually looked at him and thanked him, and he was like nodding his head. So
Yeah.
it was like as if we just met, although he's been listening to me for an hour.
That's awesome. That's awesome.
Fun.
Quick, one last comment on this. As we started, as you were going, Justin looked at me and was like, wait, is this, I can't remember. Is this for his master's or his PhD? And I said, it's his master's, his PhD is next. And Justin goes, man, I thought maybe we'd have to start calling him doctor.
Not yet, half doctor.
Not yet. But we're on our way to Dr. Rabih. So, fresh masters in econometrics. Let's jump in. If you have anything to say about interest rates, do we have a reason to actually cut interest rates? I know this has been a big topic right now.
Yeah, it's kind of because so last year we had Jake Paul or whoever it was versus Mike Tyson, and now we have Trump versus Powell.
Yeah.
So they're going into the ring trying to battle each other. And the chair of the Federal Reserve had a conference last week. It wasn't like an official meeting. And they were asking him about, like, are you going to get the interest rates? And where do you think the problems are? And usually the Fed does not point fingers. But this time they decided, he had to fight back. He pointed finger. And he said, the problem with the federal government and the fiscal policy is not our problem. The biggest components that are affecting U.S. debt are Medicare, Social Security, and these type of spending. This is not a Fed issue. So he was pointing fingers, and in a sense, said that as long as the economy stays strong and we do not get data that it is weakening, that unemployment is going up, that GDP growth is slowing down significantly, we do not have a reason to cut interest rates because our credibility is on the line. The way that we've done it and the way we've learned how economies function tells us to do so. So in a sense, they trash talk left and right, but it's really, as it seems for the Federal Reserve, it really depends on the data that comes in. And something that I noticed they were not talking about in the media between, the president and the governor was that the decision to increase or cut interest rates comes as a vote from 12 committee members. So you can remove the governor, but you've got an open market committee that together they decide. Of course, there are differing opinions in that committee. Some of them want interest rates to be 2% tomorrow. Others want it to stay at 5 for a
But it's a
couple of
vote
years.
either way.
But it's a vote. It's kind of a consensus between these committee members. So changing one person, given that the voting system is fair, not just because you're the governor of the Federal Reserve, you get 2 votes instead of 1. Just because voting is fair, it's going to be very hard to change what these monetary academics think interest rate should be at. And that's why the central bank is an independent federal entity in a sense. So
Wait, who just so I know, who makes up, so you said it's a committee of 12. They're also all appointed?
yes, they are all appointed. It's a little bit more complicated. And here's the thing. We simplify it and we say, oh, we have the Federal Reserve. But the monetary, which is very similar to other countries around the world, where you have a central bank. It's like central bank that controls monetary policy across the whole economy. But in the US, we have 12 different central banks. For each is for a different geographical territory.
Yeah.
And those together reconvene. It's like, the playoffs of all banks together. And what they elect is that they have an open market committee, which is a combination of all of these. It's not like they dissolve as entities, but it's more of the committee that involves all of these. And the central governor of the central bank, or the Federal Reserve in a sense, is one appointed from these 12. So there is a hierarchy to how they get there. And I'm not sure regarding the specifics on who appoints the governor for the regional central bank, in a sense. Could it be the federal government? Could it be the governors of the states in which that is? I really do not know these details in specific, but it's not as simple. And like everything else in the US, it's like multi-layered, where you get off the 50-yard line, then you have to worry about the 40-yard line. Like, there are so many stuff going in there, which is good. It's bureaucratic and frustrating, but in a good sense does not allow one decision to just roll the ball all the way to the end of the field and, go into hyperbole, which is where stability shows up.
And obviously, I love this summary. And then there's, obviously a reason, there's been, like you said, a lot of, I like that you referenced the Paul Tyson fight, but a lot of back and forth between the two. I think Trump has since kind of backed off. The fact of the matter is Trump can do nothing. He does, the executive branch does not have power for good reason, right? To keep them separate. You can't centralize that much power. That's the whole reason we have the separate monetary policy from fiscal policy. But for all of the crap talking, like, there is nothing Trump can do to fire Jerome Powell. I think he finally realized that, and then since has backed off.
Yeah, the Jerome Powell term ends in, I
Next
think,
year?
yeah, and either May, March, June, like mid next year. It's not even till December. And at that point, the president can decide whether to reappoint him or to appoint someone else, someone new. So that is where it happens. If it wanted to happen before, it can't just be by like signing an executive order or a decision. There has to be going into a court and proving that he has been guilty of something major: treason, money laundering, etc. Like those very big names that not only would get him out of his position, but ruin his life. So at that point is when the president actually has tools. Does he want to go there? The markets love Jerome Powell. He has communicated very carefully their policy, although they weren't as optimal as the market would like them to do, but overall they did a really good job, whether it was during COVID, during the inflation period, right now, looking at the data, especially by making sure that long-term inflation expectations are well anchored and the credibility of the US as a provider of a reserve currency was not tarnished. So getting rid out of him in that way might actually erase that soft power progress that the Federal Reserve achieved over the years.
By the way, wasn't Trump the one who appointed Jerome Powell?
That is true. In 2017, that is true. And here it is. So Jerome Powell, the appointments are political. Jerome Powell is a Republican. Given that you are, now taking a certain responsibility where you take an oath to preserve the infrastructure of this country, etc., you should put, your objective duty above politics. And that is why mainly the Federal Reserve is separate from monetary policy, because there will be times where politics and monetary policy will align, and that is good. But sometimes when they contradict, and you don't want one to influence the other, because that might give you some short-term great wins, but be bad for the economy on the long run.
Still a lot to still play out as always with.
Yeah, we don't have a meeting. We don't have a decision in April. We have a decision in May. The market is not pricing a probability of a cut in May, but probably a cut in June. So it's gonna really depend on the amount of data and economic data that we receive from now till then. The Federal Reserve stance is still that there are 2 cuts throughout this year. The market is pricing like 3.5, but by the next 12 months. So it's also around 2 to 3 by the end of this year. Not a lot of difference. And that is because we still did not get new data. Like the data post April 2nd, which when all, the shift that everyone's talking about happened, we still do not know 100% what the implications were. That's why the stock market is still in limbo, etc., etc. The only piece of data that we have received this week, next week is going to be a very fun, at least for me.
Real busy week.
Yeah, at least for me, this 2 cents episode will be a little bit more technical next week, but because we're getting Q1 GDP, we're getting inflation, we're getting a more unemployment data. So it's going to cover all bases of the economy. But the only thing we got this week that was meaningful, we get a lot of data, but that's meaningful, was the continuing claims, which is continuing jobless claims, which refers to the actual number of unemployed or currently receiving unemployment benefits who filed for unemployment in the last 2 weeks. So if you applied for unemployment and you've been on it, every single week we get initial claims. The cumulative addition claims that are still outstanding are considered the continuing claims. And I have a graph for you, but I'm going to describe it for people. Pre-2023, those claims were around 1.4 million. So at citizens. So usually we have around 1.4 million people who are on unemployment taking the benefits continuously. And in 2023, that thing started going up, but at a decreasing pace. And by the mid 2024 until now, it has kind of stayed at 1.8 million. The latest number we got was 1.84 million. So the number of people who are unemployed has been constant since, I would say, June 2024. Think about all the data, all the news, all the media frenzy that has happened since June 2024. Or like if you just try to recall and remember what you were listening on the news since June 2024, you would expect that unemployment has gone in a direction at least.
Yeah.
The fact that it has been staying flat for them tells you that the labor market is still at its equilibrium. Back in June 2024, the market had just made like 25% in 2023. It has been up like 16% so far in 2024. People were still bullish. It ended up the year at 23 plus. The rhetoric back then was much more optimistic at the same level of unemployment, which, affects our calculation of what the economy growth is going to be. And right now, that unemployment level is still as is, yet the narrative is completely different. The stock market is crashing. So, and that's why we don't have a reason yet, because the main indicator of whether we are going into a recession, which is increasing unemployment numbers, is still not there, which means the Fed is gonna wait until that happens. The Trump administration will keep calling the chairman too late Powell, and we will have to weather this storm until we get substantial evidence that we need to direct the economy in a certain way or.
And I guess the motivation for Trump is to push him to lower rates sooner, is to, I guess, minimize any impact, or maybe in their mind, to minimize the impact of tariffs and everything that the administration's causing, keep the economy, or even preemptively have the economy not be hit so hard. Is that the main thing.
100%, because of what we know of the administration plan so far, it's multifaceted. So they do tariffs on one end to raise revenue, and there's also the trade balance aspect. But net impact on economy standalone, if you only take tariffs, decreases economic growth. So you have to stimulate economic growth somehow for them to cancel each other out. They are trying multiple ways. There are possible talks about tax cuts that have to be passed through Congress. There is the pressure on the Federal Reserve to cut interest rates. There is I don't know, hope that the American consumer keeps spending and the confidence stays high, which is not what's showing up in the data. So you can raise tariffs and readjust, negotiate your trade balance, and at the same time not harm your economy, but it doesn't happen by only pushing one lever. You have to do something else that negates the impact of the tariffs. And I think they're just trying to figure out the most efficient way and the fastest way to do it before the tariff information starts coming in. But the tariff conversation is really interesting. We'll leave it to another time, but there is a chance that the impact of the tariff, although it's going to slow the economy, is not going to indicate that we're in recession. We said that in Q1, which we will get next week, and that's why it's super interesting. And the market will move next week because of that.
Stay tuned.
Stay tuned. We say that companies were front-loading and pre-purchasing imports ahead of the tariff deadline because they do not know how much that is going to be expensive. We saw imports jump up, which will lower GDP. But now, based on very early data in the week of April 2nd until April 8th, we saw that the amount of imports decreased dramatically in the US, which means if you are looking at Q2 numbers, that is helpful for the GDP because you're not importing as much as you do. So if I'm thinking of it from the perspective of, are we going to get 2 consecutive quarters of negative GDP growth? And if we're only looking at tariffs, there might be a chance that Q1 will be negative and Q2 will be positive simply because people decided to import earlier than they used to. So there's still a lot of question marks, and only when data shows up will we know how it pans out. And there is still possibility for positive news better than expectations at the economy level, at the earnings level, that we might get lucky, but we also might drift in a hurtful direction.
Yeah. And just for some perspective, because that's what we like to give on this show, when we talk about the stock market, and you were saying earlier, kind of referencing, and we've referenced this before, like the narrative just doesn't match reality a lot of times. And especially right now with all the chaos, the S&P just this week up 5%, and year to date still down only just over 6% for the year. That's just the S&P. We can go through there are others, but just to again highlight, and we've said this many, many times, like that is a normal year. That is such a normal to see something within that single digit negative intra year is totally normal. Now, to be fair, I think the week or the month leading up to this last week, the S&P was down 5%. Now it's up 5%. It's just a lot of volatility. That's one thing we're going to for sure expect, I think, for the rest of this year is quite a bit of ups and downs. I think it was, Rabih, a few days ago, we had a negative 2% day followed by a positive 3% day. It's just kind of crazy volatility we're seeing right now. Any comments or thoughts on that in particular?
This volatility does not mean that there is new information. It's not like one day we are waking up and there's the best news in the world and we're ready to go up 3%. And the next day we hear the worst news in the world and we crash 4%. This is not what is happening. I know that we say that the markets are the largest computer in the world. They are the largest information crunching machine that humans have. But it works on much larger timeframes. It works on timeframes of weeks, months, years. That is when the market really reflects all available information. On these intraday, couple of day period, those are literally impacted by the flow of money. So just simply you deciding to, deposit some money into your account because you have an extra savings, but imagine the whole country is doing it at the same time by chance, that will rise the market by 3%. It does not mean that there is any material or significant information about the growth of the economy. It just happened that we are moving money from one place to another. The fact right now that there's uncertainty is kind of pushing all people to go into this herding behavior where they all do the same thing at the same time. And this is amplifying the swings, but it does not mean that there is more information just because the swings are larger.
Yeah, it's a good point. I know one thing in particular, and we can move on from this, but just from the tariff front, I know the big news this week was that Trump, it's been confirmed that he met with China officials. They didn't confirm who was in the meeting, but I know there was talk of them going back to the table and actually starting to negotiate, which I think it gave some sense of relief that at least they're talking. So
we'll see. It's very
yeah,
political because I also read articles where this Chinese said no communication has been done. So it is, left and right. It's so politicized. It's just trying to one up each other, even on the tangential stuff, like not even talking, but whether they decided to interact or not. And it just, dude, politics, So just forget about it. Look at it a couple of months from now, and it'll be very silly once you look back at it.
Yeah, it's wild. We got tons of content on it for 2 cents. So that's
making my job
we
easier.
like it. We're fine with it. So all right, on to student loans. Haven't talked about this for I don't know a month. So might as well throw it in here. But we wanted to talk about, is the student loan party over? So pretty big news. I think this came out a couple of days ago. The Trump administration announced that the grace period is officially over. So just to give you some numbers and what that means. First, they said beginning on May 5th is when the 5 million borrowers who are delinquent, meaning they haven't made a payment over the last year, are going to be sent to collections, or they're going to basically start coming after that money. Just for kind of 30,000 foot view, kind of overview of student loans, around 43 Americans or 43 citizens in the U.S. have federal loans totaling about 1.6 trillion in debt. More than 5 million of these accounts have not made a payment in the last year, but they've been kind of in this grace period where the administration basically just said, like, don't worry about it. Education department came out and just said, we're done with this. We're going to start collecting. Interesting. 38% of borrowers are in repayment and current on their student loans. So, which means the 62% are not. So significant impact there. I was interested though, Rabih, and I want to get your take on this. I saw an article kind of when I was researching this. It was like, are student loans going to put a bigger squeeze on like the housing market? Meaning like, kind of straining people not to be able to buy homes. And I'm like, something didn't sound right about that. So I wanted to look, I was like, what's the average student loan payment?
Mm-hmm.
Like, okay, now payments get turned back on. This obviously in particular
compared to a mortgage payment in a sense.
Yeah, I want to know, like, okay, what's the strain on the average American? If like the average American with student loans has not been making payments for the last few years, what's the payment that's going to get kicked back on? Do you have a guess? Just what would you say? This is obviously not dentist. This is just the average American.
$120. I don't think it's high.
Yeah, so this according to Earnest says, as of July 12th, 2024, the average payment for federal student loans was estimated to be around $500.
Wow.
So bigger than, I agree with you. And let me see. So this shows the average student loan debt for borrowers in the U.S. is about $38,000. Not to trigger any dentists out there that are going to be. Oh, sorry. Let me rephrase. That was just one group, but this says there's actually a range. It's really hard to get this data, but this says the monthly payment ranges from, this says $100 to $400. So a couple different sources here. Somewhere in the couple $100 range, let's say. The reason
less than 1,000, more than 100.
There you go.
Okay.
There you go. But I think that's important because when we talk about the impact, like, I think it is interesting that the Trump administration is choosing to like make this a thing right now with everything going on. It just seems like they're just going all out. Like, we're going to just implement all this stuff. It does seem like weird timing to not just kind of keep kicking this can down the road. It is interesting because I think it's intuitive to think that this is going to cause even more strain on the economy, possibly, or just add one more thing. But then when you think about it, I'm like, all right, this is probably for the average person that's been delinquent, probably a couple $100. I don't know if it's going to be like life-changing situation, but maybe that's me not having enough empathy. Rabih, what are your thoughts?
Honestly, do not know, but I'm guessing that there is a correlation between whether you have student loans, and I'm not talking about dentists. I know those are very specific, and the type of degree that you got. Because there are some type of degrees where you take a student loan for them, and it's going to be very hard for you to make the money that pays off that loan in the job market. I'm kind of thinking of the non-STEM degrees because The amount of loan, like college is college, whether you decide to do a non-STEM versus a STEM, maybe they differ by like 10-20% in terms of the tuition, but the amount of income that you're going to be getting out of your first job is much, much larger. So I actually think that those people, due to their income, that number that's above 100, below 1,000 might be a very big portion of their paycheck. So yeah, we do not know, because that will also translate on this demographic, how much of the tax revenue that they provide, or how much of the houses they own, etc.
Yeah. Yeah. It's a good point. According to just to that point and kind of reinforce that, according to the Federal Reserve Bank of Philadelphia, one of the regional Federal Reserve banks we talked about earlier, they did a survey and they found that more than half of the borrowers who did not make their first full payment in October 2023 apparently cited the reason being they could not afford it. Now, how accurate is that? I don't know. It's self-reported data. People just being like, I didn't make my payment because I can't afford it. Well, that again, is that actually true or not? To be debated. But I think you're right. I think there is some concern there of the type of degree that you have. Again, this isn't necessarily speaking directly to dentists. I think this is more of just like, I think the reason why this is interesting and worth noting is, again, kind of the macro environment we're in right now and all the different things that are happening. And like, we're kind of feeling like we're on this, like, kind of on the razor edge of one more thing pushing us off into a recession. And this just kind of feels like it's pushing, possibly put, or it would make sense to say, to make the argument like this is pushing it even more.
The US and consumers are invincible spenders, but if you hit them with higher student loans as a cost, higher prices due to tariff as a cost, etc., at some point your discretionary income will dry out, and you might take loans for that, but or credit card debt, but then you've got more costs in terms of interest. So it becomes into a cycle. Honestly, literature tells us that there are debt cycles in the economy, credit bubbles and credit deflation. So it will not be surprising that certain factors showing up might slow down consumer spending. And because businesses go through cycles, economies go through cycles, our spending habits go through cycles. So the fact that, oh, the American consumer will never be at a point where they can't spend anymore, or they can't spend anymore, is false. There will be a time where we can't spend, although we've got a really good run the last couple of years. Will the timing of that coincide with what's happening right now and, push it even further into a recession? Maybe. We do not know. But maybe all the tariff stuff are done. I'm taking an optimistic path over here. You negotiate new trade agreements where tariffs are lower, prices are lower, but it still happens that the consumers, due to other factors like student loans, slow down, but that might happen in a couple of years. So the magnitude of the magnitude of the slowdown from lower spending might either match with economic conditions that exacerbate it, or match in economic conditions that mute it, and we would not see it as much. That's why it is complicated. You've got cycles and they are different wavelengths, and if they match, they amplify, but sometimes they cancel each other. We'll see. Honestly, we'll see.
We'll see, and we'll cover it here. We're going to talk about it. For what it's worth, to finish up this segment, to your point, Rabih, everything's political, but the Secretary of Education, Lyndon McMahon, direct statement regarding this policy says, and taxpayers will no longer be forced to serve as collateral for irresponsible student loan policies. The Biden administration misled borrowers. The executive branch does not have the constitutional authority to wipe debt away, nor does the loan balance simply disappear. So again, I see that side. I really do. I see that this becomes really political, but I do understand that take of just saying, like, we can't just wipe this away. Like, I do understand this idea of, like, you chose to take the loans out. Like, the loans are now on your balance sheet. Like, you got to pay the loan. I do get that. I know it's not that simple, but it does. Again, it makes sense. And I don't think the executive branch truly does have that power.
You have to let the math add up. And I think a big part of the reason is, like, they know that a portion of those, let's assume that they're going to go with the hypothesis or the narrative that, yeah, a lot of those consumers will not be able to afford their student loan, as this report is saying. Well, who's going to take the loss? Is it going to be the federal government, or will it be those third-party loan providers that are private entities? And then will the loss be taken out of the private sector? Corporations will handle that cost because corporations are supposed to go out there and take risks. Or will the government, who's already struggling a lot with its finances, it's like, Honestly, if the government was your, brother or sister and they're in that much debt, you'd be like, stay away from me. So does the already struggling federal government have to take that loss on that, write these off as well, and add to a problem that they already have? This is purely at the intersection of politics and economics. There's a loss, and who's going to take it? Is it going to come out of the consumer, out of the corporation, or out of the government? Because the math has to math, and you can't just make it disappear.
Yeah. Yeah, it's a good point. And I think that's kind of what they're saying. Like, we can't keep doing this, even if the timing is not great. Okay, more to come on that, along with all these other stuff. The last one we just want to hit, kind of a fun one. We teased this last week. You'll notice we took the inflation one away this week, even though I teased it last week. We're going to hit it next week because Rabih said new data is coming out next week. So we'll have a lot more to talk about with inflation. But this last one, we'll just keep this quick. We just thought it was kind of fun. This actually comes directly from a client of mine. A couple of weeks ago, we've got vacation season coming up, and my client reached out and just said, "Hey, like, how much should I spend on vacations? Like, what part of my cash flow or my budget should go towards vacations?" And I thought this would be a good thing to just kind of chat about. First thing that I'll say is, you're gonna hate this answer, Rabih, and people are gonna hate this, but the truth is, the worst but most accurate answer of this is it totally depends. It totally depends on your specific situation. But I think what they're looking for, and I think what people want to know, is just like, what's a general kind of guideline I should follow? So if you're going by a guideline, I would take a step back and think about framework of budget. I think one of the most commonly used frameworks, and I actually like this one a lot, and I want to get your thoughts on this, Rabih. But if we just back up a little bit from specifically vacations for a moment, I think the best framework I've heard, and that I've actually shared with people before, is the 50-30-20 framework. Have you heard this? So 50% of your pay of your income goes towards your needs, 30% goes towards your wants, and 20% goes towards your future savings investing. I like that framework just as a general rule. Again, if we're talking generally on a podcast or just sharing it out there with the world in like an article, I think if you could do a lot worse than just, I think that would be a favorable thing to just kind of follow. So I'm going to stop there for a moment, Rabih, and get your thoughts on just generally speaking, that framework to start.
Yeah, it is a framework that helps because now you know your ceiling, your upper limit on whether you want to spend. Something that actually causes me a confusion, like I really want to know this answer. Matt, my financial advisor, please give me the answer.
Let's do it.
But the idea is like, we have rule of thumbs for like how much of a house payment should be as a percentage of your income, how much of a car payment should be, etc. Do we have one for vacation? Or is it just going to be part of that 20% in the 50-30-20 rule?
Yeah, no, I think we really do. And the reason I wanted to start kind of more broadly is because you just said it perfectly. And the reason why it depends is all of this is a game of trade-offs, right? So just to go with your example for a moment, we do have some recommendations or some guidelines of like homes, right? Of how much of your budget should go towards a home. So we'll highlight that. We are a little bit more conservative than, like, let's say a bank. A bank will go up to like 40% of your income, which is crazy to us. We actually start around 20. That's kind of the line in the sand to start. We will have a client, we will kind of say you can go up into the high 20s or even 30, depending on your stage, 30% of your stage of life. Like, is there a reason to believe your income is going to only go up over the next few years? Like, we can kind of predict that a little bit more. But the reason I'm highlighting that is because, Rabih, to your point, like, let's say a client says, I really value vacations and I really want to spend a lot more of that 30% of this 50-30-20 rule. I want to spend most of that on vacations. And I'm fine like renting an apartment for the next 5 years and not worrying about a house, or maybe the next 10 years, or maybe never buy a house. Like, that's an extreme example, but that's possible. And so that's why I think guidelines are good to give you direction. But I don't want people to get too hung up on it, because that person in particular versus the other side of the spectrum from this house vacation dynamic of someone saying like, no, I'm a total homebody. I love to garden and I don't really care about vacations. Like, I'll go camping maybe a couple weekends this year, but I just want to have like the best, nicest house. I just love it. That depends on the person, right? But that's dissatisfying to you, I know. So let me give you an actual answer of what I think would be a fair percentage for a dentist to be thinking about.
Okay.
I'd say about 10%. About 10% of your income every year towards vacations. If you want to be more conservative, 5. If you want to be a little bit more aggressive, maybe 15. But like, I think about 10% of your income, if you use that on vacations, I'm like, that's probably a pretty fair number to get you a good vacation year without going crazy on your spending.
Yeah. And then it's up to you to determine whether you want to blow it out all on one vacation or spread it for 2 or 3 smaller ones or
Yep.
4 smaller ones.
Yep, exactly. Now, at the end of the day, what this comes down to truly is, again, where's your other spending going, all that. But to me, it's, are we saving enough for the future? Do we have that kind of stuff taken care of first? The rest of your money can go towards whatever you want. So as long as you've got that savings bill taken care of and you're investing in your future, again, our take is, 15 to 20% of your income is going towards that. And you want to live in a shanty and then just live luxuriously on vacation every year and spend 30, 40% of your income on vacations, like, go do it. But I think 10% is probably a pretty good figure to be kind of a baseline to be working off of. Any final thoughts on that?
Yeah, I'm going to throw you a curveball. And this is me. I'm going to be vulnerable, but we do not judge here.
Never.
Here's the thing. I stick to a really good budget on everything in my life, except when it comes to travel. Because for me, I value travel and the freedom to just explore more than anything else. That when I'm looking at post-trip, when I spent more than I was supposed to, and I look at my spreadsheet, because of course I have a spreadsheet, I say, oh, I went overboard over here. But what am I saving for in life anyway? I'm saving for this. So I kind of convinced myself, but I know I'm one of those even extremes when it comes to the vacation portion or the traveling portion, even taking part of the 20 savings, which I hope I hold myself accountable by saying it out loud on this podcast.
No, I mean, this is a whole other discussion, Rabih, but I don't think you're off base on that at all. My view on this over the years has changed drastically. I'm just with things that have happened in my life. And I think everyone's kind of changes their views based on experiences that they have. I love that. And I think you're totally right. Like, what else are you saving for other than to have experiences? And in a lot of ways, it's like, yeah, you should be having those experiences now. There's obviously a balance, but I'm actually all for people kind of, as long as they're doing it like, doing it responsibly, not going like credit card debt to take the vacation of a lifetime. But if it means you're hindering some savings, maybe you're not saving, you're not maximizing or optimizing your savings because you want to go, I hear this a lot from clients. I've got actually quite a few clients that are in the stage of life where they've got like high schoolers, right? Or I got a lot of clients this year who have kids graduating high school, and, maybe they've got junior highs all the way up to high school kids. And they're like, this is it. Like, this is the time of life that, like, I'm not going to get this back. Like, I'm not going to get, like, they're going to move on. They're going to go to college. They're going to get married. They're going to be their own people. And like, yeah, we'll still see them, but I want to kind of take advantage of this time. And I'm like, yes, let's freaking do it. Like, this is the time to do it. And for someone like you, for someone like our clients, you've got to think about the fact that, let's be honest, you're not the typical person in the sense of like, your human capital is worth more than the average person. And just your ability to generate income is much larger. And so that has to be taken into account when we think about future savings and spending now versus later. Like, that has to be taken into account. Does that satisfy
That
you?
answer. Worth so much money. We should make this podcast paid. This episode, because
there's going to be a paywall for this. Speaking of vacations, Rabih, part of that budget, I would actually advocate for someone going over that 10% budget. If it meant they were coming to Park City in June, it's basically going to be a vacation that you can get CE, hang out with the DA team, hear from incredible speakers. It literally is a vacation. But if you're a practice owner, we're not a CPA, but we'd say probably just put it on the business.
it
Make it
pays
tax
for
efficient.
itself in
Yeah.
fulfillment and
Consult your
tax
advisor.
cuts.
But Dentist Money Summit, June 20th and 21st, we'd love to have you come out. We've actually, Rabih, had quite a few over the last few weeks. We're building momentum. It's kind of crazy how many people are signing up. Super excited. We're going to have, right now, honestly, by our estimation, probably 200, 250 people there, plus our team. So it's going to be a packed house. Super excited if you're able to come out, meet Rabih, the newest, freshest masters in econometrics. Maybe we should do a segment like Stump Rabih or something like that. Try to stump Rabih with a market or economy question. But no, we'd love to have you out. You can check it out, dentistmoneysummit.com. Rabih, any final words for the people?
I'm so excited. Like now that I don't have any exam to look forward to, all I want is to hang out with, our clients and our friends at the summit. I'm super excited
It'd
for
be
it.
so fun. Yeah, we'd love to have you out. For now, everyone, thank you as always for listening. Rabih, thank you for being here. That was our 2 cents. Till next weekend. Bye-bye.